Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel. My name is Jesse Day, and we're already counting down to the next VRIC, January 21st and 22nd at the Vancouver Convention Center. As soon as tickets become available, I will let you guys know. But for now, we're bringing you guys interviews with great guests. And today's guest is the co-owner and publisher of Daily Profit Cycle and Resource Stock Digest. It's Mr. Nick Hodge. Great to see you.
It's fantastic to be here, Jesse. Thanks for having me.
Yeah, thanks for being here. We had a really fun panel at the VRIC this year on uranium, so hopefully we'll be jumping on another one next year. But I want to get started here, and that is with the first major bank failure since 2008 in the United States. And I think the news cycles have just been moving so quickly these days with people chasing the next shiny object that a lot of this is not really being paid attention to as much as maybe it should be. So do you think there are any long-term implications to the SVB collapse? And do you anticipate seeing more cracks in the system up ahead?
So I think what happened to SVB was relatively isolated. It was a pretty good candidate to have a bank run, given that the deposits it held were concentrated in specific industries, mainly tech, and it didn't have as good of management practices as some other large regional banks, and certainly not as good risk management practices as larger banks. As many of your listeners probably know, this was a liquidity issue, not necessarily a credit or a default issue like it was in 2008. This was money came into the banks on the back of stimulus and higher revenues in late 2020 and 2021, and those banks had to put that money somewhere, and they actually put it in relatively safe places, treasury bills. The problem is that those bills are now at a loss because, as we know, rates have gone up, and so bond prices have gone down. And when those large depositors, who by the way were having more than the FDIC limit in those accounts, went to withdraw funds, then the bank had to sell those T-bills at a loss, and that begets a liquidity problem. So the Fed stepped in. We've seen it relatively contained, and it points to a couple of things, and I think there are a couple of longer term implications. One, I think it benefits the big banks. We saw near record outflows in recent weeks from smaller banks, and we've seen larger banks, see inflows. But I think it also lit a fire under some people starting to scratch their head and say, hey, how safe is my bank? Where else can I put this money? And on the back of that, you've seen, gold do what gold's done, go to $2,000 an ounce. And the other thing I think it portends is just general tightness in the economy, general tightness with consumers and with businesses. And I think you'll see it, trickle or spread out into other areas of the economy, because you're going to see banks be more hesitant to lend. It's going to affect commercial lending. It's going to affect the profitability of banks. And I think that's a symptom of the economic contraction that I've been saying we were headed into, or that we're currently in. And not necessarily the main thing to be looking at. So, and then down the line, we'll see if it does get worse, what the Fed has to do. Ultimately, I think this is going to cascade into a deeper recession that's going to culminate in higher unemployment. And that's what's going to lead the Fed to pivot. And then maybe we can talk about that a little bit more as we go.
Yeah, you've also mentioned in terms of the broader market that you don't think the bear market is over. So I'm wondering how much more pain you see coming for the broad market, and will mining stocks suffer alongside the S&P, do you think, if there's another leg down?
Yeah, there's still a lot of hopium out there. I realize that the S&P has broken above its downtrend line, and the bulls are very vocal right now, saying that the bottom has been put in. I'm not so sure, and lots of indicators say that as well. We've still got a significantly inverted yield curve as it relates to the 10-year and the 2-year, and perhaps more importantly, the 10-year and the 3-month. You've got slowing corporate earnings. We're starting to get Q1 earnings now for the S&P. I think something like 18 or 20 companies have reported so far, and they've got negative earnings growth still. ISM numbers were out recently, and they show contraction in the services sector. The numbers continue to go down and to the right, not up and to the right. So that tells me that the numbers aren't going the right way yet. And we see consumers starting to be strapped as we get credit card balances that are, back above pre-pandemic levels, and then are also those consumers are having to pay, record high interest rates on those, somewhere 19 to 21%. So I do think there's more pain ahead. How much downside? That's a crystal ball question. Let's look at a past example and let's bring the debt ceiling into it, I guess I would say, because we've got that fight coming up in June. And we've seen, US CDS credit default swap sort of broaden out and rise the same as we did the last time there was a major fight about the debt ceiling, which was in 2011. So for the past couple of years, it's been swept under the rug. There's always a debt ceiling issue every year, but it hasn't been with the conditions that we're seeing now since 2011. And when that happened, we saw a quick downside in the S&P, some 20%. So I've said a couple of times that I think we go back to at COVID levels in the S&P, that would be another 20% down. Not necessarily the COVID lows, but like 3,000, 3,200 on the S&P, for example. And then, yes, to your question about the mining stocks, they're stocks. They're not immune from broad-based sell-offs. And so that's why I've said, as we see this downside in the coming months in Q2 and in Q3, that's going to be the time to buy the fear, as it were, right? To build and add to quality positions, not just in commodities, but elsewhere that you want to hold for the longer term, because everything is cyclical, and we will get back to growth down the line, and we will get back to a normalization of rates, even though they're actually at normal levels now, but not normal relative to what we've seen in the past 10 years.
Yeah, very good points. And you mentioned a recession earlier, and you've said that you firmly expect a recession, which is already leading to softness in commodity prices. But you think on the other side, you see a bullish environment for commodities. So could you walk us through that? How big of a bull cycle are we looking at here? Because there's those who are in the camp of it's a commodities super cycle, some people a little more subdued. Where do you stand on how big that bull market could be?
So I think we're in a commodity super cycle. I believe it started in 2020. And I think it's following a similar path as the last one. The last one kicked off around 1994 and had a really strong run until 1997 or so, if you look at a chart of like the CRB commodity index, for example. But then what happened is we had the dot-com crash, and the CRB commodity index retraced all its gains that it made from 1994 to 1997 until it bottomed out in 1999. But it was still in a super cycle that lasted until 2008. And so you get pullbacks amid these broader cycles. And I believe that's what we're seeing now. So I do think we're in a commodity super cycle, and I think we're just seeing a pullback as a result of economic contraction, which is only natural.
Right. And you mentioned Fed policy earlier as well, that maybe we could delve a little bit more into that. It's always this question, almost get sick of talking it. Are they going to pause? Are they going to continue hiking rates?
Yeah.
Are they going to pivot and start cutting? And how will that affect the broader market? I have another channel, Commodity Culture, and I talked to Michael Oliver recently, and he said he thinks that the Fed will be forced back into QE at some point, and that liquidity is going to go into commodities ultimately as kind of almost a new safe haven, a place people will run to. What are your thoughts there on what you expect from the Fed up ahead, and how you think their policy might affect the commodity space?
So I think the Fed's got another quarter point hike left in them. That's what the market is pricing in. I think they've returned to a little bit of easing. I mean, they created a special program for the regional banks that we saw. We were just discussing SVB a couple of minutes ago. And so you see that they're willing to step in and provide liquidity where it's needed. I think here's what's going to happen. I think ultimately they're going to have to abandon their 2% inflation mandate. I simply don't think they can get it that low. Despite the fact that inflation has peaked. Look, it's down from 9% to we're recording this on CPI day. I know this won't come out for a bit, but it's down to 5%. But I don't think they can raise rates high enough without breaking more things in the economy to get it down to 2%. So I think they're going to have to abandon that part of their dual mandate, and then it's going to be employment, like I say, that's going to ultimately make them pivot later this year, perhaps in in July. How does that relate to commodities? Well, it provides a tailwind, not just for commodities, but for, I guess I call gold a currency. So for gold as well, because while we've had a relatively strong dollar of late, the Fed reversing policy is going to make the dollar a bit weaker, and that's good for commodities. That's good for precious metals, and it's good for emerging markets as well, which is one reason I've started to buy China in the past couple of weeks here. I don't know if that's good enough prognostication for you, but that's sort of how I see it playing out over the next couple of months. And we'll have to see what else develops. I don't know what's going to break, or, if it's going to be a sustained pause, or they're going to have to cut depending on how bad it gets. It's sort of too early to make those calls. And I'm not really in the business of making those calls, but positioning based on what actually happens as it happens.
Yeah, so emerging markets, I really would like to get your take on China. What do you see there that presents opportunity? And shouldn't investors be worried about potential sanctions similar to those levied against Russian securities that severely affected the ability to trade them? Could something like that also happen with Chinese equities?
I don't see the restrictions happening in the near term. China likes to puff its chest out a little bit. We saw them do the war games around Taiwan when Nancy Pelosi visited a couple of months ago, and we saw them do it again here recently. They've threatened to cut off supply of rare earths, which I feel like they threaten every year or two. We'll see if it actually happens. But the reason I've been getting bullish on China is it was the first thing that set it off was the reopening, right? That was the main catalyst. But the other thing is that it's not doing what the rest of the world is doing. One, there's an actual monetary expansion. If you look at M2 money supply in China, it's expanding, whereas it's contracting in the US. And so, we talked about liquidity concerns already with the banks. There's fewer liquidity concerns in China because that money supply is expanding. We also talked about PMIs here, or the ISM numbers. I mentioned earlier that are contracting in the US. Well, they're expanding in China for the service and the manufacturing sector. And so those are the main reasons that I've been getting bullish on China. And, I do that through ETFs. And so when you talk about worrying about, sanctions or investors not being able to buy, I'm buying widely held iShares emerging market ETFs, for example. I'm not, buying stocks on the Shanghai or the Shenzhen or Hong Kong exchanges or anything like that. So that's not a worry that's in the forefront of my mind. And again, back to the policy, the dollar has been strong, and as that weakens, that benefits, the emerging markets as well. So China is a decent place to put your money right now, as opposed to the U.S. equities, which I just outlined, I think have 20% or so downside.
And are there any other emerging markets you see opportunities in? Because I feel like your average investor in the West is very, very focused on their own country, whether that be Canada or the US, and they very rarely look outside of their own doors for opportunity. So are there any places that come to mind outside of China, maybe India, Brazil, and anywhere like that you also see presenting a potential opportunity?
Yeah, India is interesting. They just paused. As a matter of fact, they were in a hiking cycle and paused their rate hiking cycle. South Korea is interesting. It's been in a bear market. The Kospi has been perking up here in recent weeks, and that looks okay. And the other one I'd lump in there is Taiwan. And again, I own those all through, I think the ticker is EEM, the emerging market ETF, which I recommended in my monthly newsletter. And so those would be three that I point to. Yeah, India, Taiwan, and South Korea.
What's up, guys? Quick break. My name is Jay Martin. I'm the CEO of Cambridge House and the host of the Vancouver Resource Investment Conference. I wanted to quickly point your attention to a link right beneath this video where you can subscribe to our new weekly newsletter. If you want to better understand the minds of the best investors in the resource space, subscribe to this newsletter. I author it personally every Sunday, and I love writing it. Hit that link below to subscribe. All right, back to the interview.
Very interesting. I lived in South Korea for 8.5 years. I'll have to
wow.
look more into the market there. Yeah, very interesting. So let's run through a few specific commodities here and get your thoughts. Obviously, you spoke about gold and as it relates to Fed policy and their potential easing up ahead, as well as the SVB collapse. We saw gold rise quite sharply in that circumstance as well. And I mean, I literally bought physical gold when that happened. I'm always looking to add to my stack, but that kind of made
Sure.
me, it had a psychological impact on me right away. So how do you see, we've spoken a little bit about gold there. So maybe you could give us your view on silver. How do you see silver reacting up ahead? Because as often happens in a precious metals bull cycle, silver tends to outperform gold, at least initially. Do you see the same thing potentially happening? And what are your thoughts on silver's increased use as an industrial commodity in green technologies?
First, I got to show you my little prop here. I've been buying these to hand out to my friends. I got these little
Oh,
credit
awesome.
little Credit Suisse on 2 gram bars I was buying when Credit Suisse went under a couple of weeks ago. So I'm always looking to add to my stash, be it those are only 2 grams. But back to your question, I think I'd have to answer still in terms of gold for a couple of reasons. It's been very strong. We've seen the long-term rates sort of start to fall off. The U.S. 10-year we haven't mentioned yet. That's getting softer. And gold has been doing the inverse of that. People like to talk about the inverse correlation with the dollar and gold, but I like to look more at those long-term bond yields, which you'll see if you pull up a chart of the U.S. 10-year that it peaked in October, which is the exact time that gold started to get stronger. And so I don't really look at silver individually, right? First of all, it's really tough to invest in silver. I think there's a lot of hype and a lot of noise in the silver market. And, I can get my exposure by buying SIL or SILJ or something like that. I think gold is bullish. And so let me say that because gold is bullish, then I think silver is bullish as well. I would have liked to see a close above 2000 for the first quarter. We didn't quite get it. It sold off right at the end of March there. But it's perked up quite nicely above 2000 recently and looks strong. And so I started buying quality gold stocks late last year, the royalty companies and things like that. And I think 2000 is going to be relatively sticky. We talked earlier about the money coming out of banks. That money has to go somewhere, and the gold and silver market are very small. I was looking earlier, about the amount of gold that was above ground, and it's worth something like 14.5 trillion or something like that. That's less than the cash that the U.S. banks hold, which is at $17 trillion. And so you hear Rick Rule say this a lot. It doesn't take a lot of money coming out of other places and going into the precious metals market to, make those good places to put your capital. And so I'm sorry I'm not giving you a specific answer on silver, but I do believe both gold and silver are bullish. I'm not sure that either go to the moon, and I'm not sure they have to for you to make money. Gold and silver going to the moon means we have significant other problems out there. And while I might have wished for that while I was a younger man, I don't wish for that now, having 3 young children. So an allocation to physical, an allocation to, quote unquote, paper physical, and an allocation to the producers and the emerging producers, I think will be fine, both in gold and silver for the next couple of quarters to certainly outperform the S&P.
So how about uranium? We know you're bullish. We were on a panel together discussing uranium at length. Sentiment seems to be at quite an all-time low these days. And I think that's a symptom of the social media generation that we live in, where people are watching the spot price day to day. They're posting memes. A lot of these people don't even do the necessary research. And so they're questioning themselves constantly, but yet they have uranium in their username. And it's a very confusing space to look into from a sentiment perspective, but the fundamentals only appear to be strengthening. So how do you feel about the way uranium is positioned right now? And how do you allocate capital to the uranium sector? Do you stick to an ETF? Do you go with the Cameco and the Kazatomprom, the producers, or do you also dabble in the explorers and the developers?
Oh, I dabble. Let me take the first question, though, is the current state of uranium. The fundamentals are really strong. Everybody knows that. And, we can point to supply and demand. We can point to reactors being extended, the life of them. We can talk to small modular reactors coming online, the necessary or the need for nuclear as it relates to climate change goals and all that sort of stuff. It's not going away. It's needed and it's increasingly accepted. And what's happened as a result of that is a bit of stability has come into the uranium market. In fact, after we saw it run up to $50 a pound, it's really sort of stuck like glue there, at least for the past 6 months or so. And to me, that means that there's a floor. And so I believe that $50 is a pretty good floor, a new floor for uranium. And so, and then I look at technicals in the equities that surround the space, right? You ask how I invest. Yes, I own URA. Yes, I own URNJ. Yes, I own the mid-tier producers. I own Denison. I own Energy Fuels, but in small allocations, right? These aren't, 50, 60, 70% of my portfolio. These are each 2, 3, 4% of my portfolio, right? And they've been cheap lately. You mentioned sentiment. Sentiment was really weak a couple of weeks ago. You had Denison trading below $1. You had Energy Fuels go below $5. I'm talking U.S. prices. And those were really cheap, and I took the opportunity to add to my positions in both of those, and in fact recommended Energy Fuels in my speculative newsletter. And so I think as long as you don't drink the Kool-Aid, as long as you don't overextend yourself in the uranium equities and you don't chase, and you mentioned the people on social media, it's easy to see who owns too much uranium stocks and who chased at the highs of 2022, then it's a good place to be. And the other thing I'd say is the uranium stocks can be so volatile that you almost have to maintain those positions. Because if you don't, you're going to miss out on the upside when it does come. And it's one of those crystal ball things. I don't know what's going to be the catalyst that, makes uranium stocks do what everyone wants uranium stocks to do. It's like people are sitting there poking them with a stick, right? Like, come on, move. But when it does happen, I want to be in the market, and that's why I keep those allocations. And yes, all the way down to the explorers I own as well. Particularly, I like the explorers in the prospect generator model, so you get a bit of diversification and not just single asset concentration on exploration.
So how do you feel about copper at the moment? I've spoken to a lot of people about copper, and the supply-demand fundamentals seem very bullish, particularly with the new green economy being pushed quite hastily, some would say, by the political class, and the amount of copper needed to reach net zero by the goals they've set is like more than has ever been mined in the history of humanity. I don't think it's going to work out how they hope it will, but that doesn't mean they're not going to try. Now, a caveat I've gotten from some people I've spoken to, such as Lobo Tigre, is he thinks perhaps, although he's extraordinarily bullish for the next decade, he thinks perhaps over the short term we might see a drawdown in prices due to a potential recession. So I'm wondering where you stand right now on the picture for copper.
I'm with Lobo, and Copper agrees. It's called Dr. Copper for a reason. It's the general practitioner of the global economy, and so you see if you pull up a 3-month chart for copper that it's been trending down. It got to $5 last year, and it's been trending down to $4 here recently, where it looks like it wants to consolidate. I don't believe copper is short-term bullish, but I believe copper is exceedingly bullish in the long term. And so it relates back to, the question you asked me a couple of minutes ago, how I see things playing out with the commodity cycle and the recession. I'd be very content to add to my copper positions in the next 3 to 6 months, whether that's the Rio Tintos and the BHPs of the world, or whether that's the Filos and the Amerigos. I think there's going to be opportunity to add in the coming months. And so I don't know if that's what people want to hear, but I think that's what's going on. Copper can't escape a recession, and that's what it's pricing in by sticking so close to 4. I wrote recently that you could see it even get comfortable with a 3 handle more than a 4 handle as this recession plays out. But that doesn't change the long-term, fundamentals of copper, the structural supply deficit, all the copper that's needed for the electrification, all the things that everyone talks about.
And I want to get your thoughts now on battery metals. This is something, for some reason, I don't love battery metals. I just don't like the whole EV revolution, the way that it's being pushed. the way that these governments are trying to mandate electric car adoption. And so I feel like once again, this is going to be a situation where some of this legislation is simply impossible to actually implement. But once again, maybe they're going to push through as far as they can and try anyways, which could be bullish for metals like lithium. So what is your view? Can you change my mind here? Is there opportunity in the battery metal space that I should be considering?
I mean, I think you have to lump copper in with the battery metals as well. You know, these EVs aren't going
Yeah.
anywhere without the necessary infrastructure to charge them. And so, um, if you're bullish on copper, you're technically bullish on battery metals. You know, I don't spend a lot of time going into the I guess what I would call the niche metals, right? Like I don't spend a lot of time in graphite or tin or magnesium or things like that. But I do look at not necessarily the government mandates and the incentives, which could give the sector a tailwind, but I look at what the automakers are doing, and they seem to be pretty worried about where their supply of lithium is going to come from. You've seen, you know, these rumors about, you know, Tesla buying Sigma. You've seen GM come in and invest in Lithium Americas. And you see, you know, the European auto manufacturers like Volkswagen and Mercedes get increasingly vocal about, you know, going into the mining supply chain directly. Which is rare for these big companies. And so I am a lithium bull. You know, I look at you know, things that Joe Lowry says or that Simon Moore says at Benchmark, and if you look at the amount of lithium mines that have to come online, you know, it's simply a fact that we can't bring on enough supply in the amount of time that it's supposedly going to be needed. And I guess I would add on lithium, it had a very strong run. I mean, you saw lithium go up some 5 times in the past couple of years. It was trading at spot for $80,000 a ton of lithium carbonate in China last November or early December. And that's now down 60%. I mean, in very short order, it's come down fast. The spodumene prices have come down as well. And so if you missed the first run, it's probably a decent time to start looking at lithium. And like uranium, it's a relatively small sector, and it's one of those things that you can allocate the same way, either into ETFs or to the large producers like Albemarle, and then some of these quality, very large deposits that have come on recently, whether that's you know, Sigma, whether that's Sayona, which just went into production in Canada, becoming the only producer there, or you know, have to toot my partner's horn, Gerardo Del Real, and I guess mine as well, for being very early to Patriot Battery metals. I'd be remiss if I didn't, you know, tell your listeners that, you know, he was getting people in Patriot Battery metals private placements at 16 cents and 34 cents, and that stock ran to $17 recently. So I am bullish on lithium, and that's likely because it's been very kind to me in the past couple of years.
Right. Well, thank you so much for joining us today, Nick. For those who want to learn more, can you tell us about your work at Daily Profit Cycle and Resource Stock Digest, and where people can find that, and anywhere else you'd like to direct people online?
Sure. Daily Profit Cycle is a free e-letter geared towards retail investors. Myself, Gerardo, and several other editors cover the entire market there, crypto included. The free daily editorials you can sign up to receive. And then Resource Stock Digest is a mining company sponsored site. So we interview mining company CEOs and analysts and other writers as well to help tell the stories of several junior resource companies. So a great place to do due diligence if you're looking for information directly from the companies themselves.
Great. Well, I'll put links to those in the description below so the viewers can check it out. Thanks once again for joining us. Looking forward to seeing you at the next VRIC, and hope to talk to you again before then.
It was a pleasure, and I would love to. Thank you.